Welcome to Griffonomics.
Get to hear.
Today is Tuesday, February 17th, 2026. And, if you're tuning in, you might be expecting the usual, the Fed, the latest inflation numbers, maybe some tech drama out of Silicon
The
Valley.
usual market noise.
Yeah, exactly. The noise. But we are not doing that today. We're going to go deep on a company that I think a lot of people, even really sophisticated investors, have sort of filed away in their minds under a very specific label.
And that label would be...
Boring government contractor.
Yes. I know exactly who you're talking about. Leidos, ticker LDOS.
That's the one. Leidos, ADOS. And look, most people know them, even if they don't know they know them. They're the people who run those big airport security scanners.
The ones where you have to hold your hands up.
Yeah, like you're being arrested.
Yeah.
Or you know them as the IT guys for some government agency. It's that classic body shop reputation, right?
It is. The idea is, the Department of Defense needs 100 coders to fix a database, or the VA needs 50 people to run a help desk.
You call Leidos. It's butts in seats. It's reliable, it's steady, it even pays a dividend, but it's not exciting.
Not sexy. It's not the stock you go to a dinner party and brag about owning.
Never. But that entire reputation, that whole narrative,
It's dead.
it's completely dead.
Yeah.
Because if you actually read what dropped today, their Q4 and full year 2025 earnings, and you look past the headline numbers, that story is buried.
It's a history lesson at this point.
Yeah.
Because what we're seeing and what's been building for the last year or so is a complete metamorphosis.
That's the perfect word for it. This is not an IT services company anymore. They are pivoting, and I mean hard, to become what they're calling a national security and infrastructure technology powerhouse.
And they are backing it up with billions of dollars. This isn't just a marketing slogan.
Not at all. I was going through the 8K filing this morning, and just the sheer scale of the changes they're making is, well, it's staggering. It honestly feels like watching a giant container ship try to turn on a dime like a speedboat.
And the incredible thing is, they might actually be pulling it off. It's a massive strategic shift. We are talking about a company that is changing the fundamental physics of how it earns a dollar.
Explain that. What do you mean by the physics of it?
They're moving away from selling hours of human labor, which, at the end of the day, is a commodity game. Anyone can sell an hour of a coder's time.
Right.
And they're moving towards selling outcomes, selling proprietary technology, selling their role in building and securing critical national infrastructure. This isn't just a rebrand, it's a total structural rebuild of the business.
Okay, so that's our mission for this deep dive. We're going to generate a really granular investigative report on this transformation. We're not just going to read you the press release.
We need to get into the why. Why this and why now?
Exactly. And we're going to break it down into three huge pillars. First, we have to understand their new grand strategy, this thing they call NorthStar 2030.
That's the roadmap for everything.
Right. Second, we have to talk about the bombshell they dropped today. A massive, and I mean massive, $2.4 billion all-cash acquisition of a company called Entrust.
That deal is the key. If you understand that acquisition, you understand the entire puzzle.
I completely agree. And third, a partnership with OpenAI that, frankly, sounds like science fiction, but is apparently very real and already being deployed.
And we have to wrap all of this in the context of the numbers that just came out, because the financials are the scorecard. They
Right.
tell us if this massive bet is actually starting to pay off.
Okay, so set the stage for me. You said we need to understand the why. So why now? Why does a company that has been very comfortable for decades being the government's IT guy suddenly decide it needs to be building hypersonics, designing the national power grid, and deploying autonomous AI agents? What was the catalyst for this?
I think it comes down to two words: margin and stickiness.
Margin and stickiness. Unpack that.
The body shop model.
Yeah.
Hiring thousands of smart people and billing the government for their time. It's a low-margin game. It's intensely competitive.
Because if you bid a project at $100 an hour, your competitor can just come in at $98.
Exactly. It's a constant race to the bottom on price. There's no real moat, and the work isn't sticky. When the contract is up, the government can just hire the other guy who's a few bucks cheaper.
So there's no loyalty, no proprietary lock-in.
Very little. So Leidos leadership looked at the future. They looked at where the real geopolitical threats are, and they looked at where the money was going to be, and they realized the future is in owning the technology, not just renting out the people who use it. And that realization became NorthStar 2030.
Okay, let's unpack that name, NorthStar 2030. I have to be honest, that sounds like the kind of name that comes out of a corporate branding retreat.
It does have that ring to it.
Every company has a Vision 20 whatever slideshow. Is this just a fancy PowerPoint deck, or are you telling me this is a real, concrete operational roadmap?
It is a very specific, very operational roadmap. At its core, it's about a fundamental shift in their business model from services to solutions.
Okay, what's the practical difference between a service and a solution?
Think of it like this. In the old service model, the government pays Leidos to send 10 engineers to, say, manually inspect 1,000 miles of power lines. If that job takes them 100 hours, Leidos gets paid for 100 hours.
Right, you bill for time and materials.
And in a weird way, that almost incentivizes being slow. If you do the job too fast, you bill less.
Right, you get punished for being efficient.
Exactly. But in the new solution model, Leidos doesn't send 10 engineers. They sell the government a proprietary drone platform equipped with their own AI software that inspects the same 1,000 miles of power lines in 10 hours. That's velocity. That's scale.
And they get paid for the value of the solution, getting the job done,
Yeah.
not for the hours it took.
Precisely. If their software solves the problem in 1/10 of the time, they still get paid the same or more because the value delivered is higher. And that means your margins just explode.
We're talking about a completely different financial profile for the company.
A completely different world.
Yeah.
You're moving from, maybe high single-digit margins in the services world to potentially mid to high teens, or in some cases, even software-like margins.
So to achieve this, they've laid out specific areas they're going to focus on, these growth pillars.
Yes, 5 of them. And these aren't just random. These are all areas where they believe the government has a critical need and where Leidos can build a defensible, technology-based moat.
Okay, walk me through the 5 pillars. Where is Leidos betting the farm for the next decade?
Pillar number 1 is space and maritime. We're talking about the undersea domain and the space domain, 2 areas where conflict is increasingly likely.
And specifically within that?
The big focus is on autonomous vessels. Think robots in the ocean.
That's a huge deal right now.
Yeah.
With everything happening in the Pacific, the Navy is absolutely obsessed with this ghost fleet concept.
They have to be. The Pentagon knows it cannot build manned destroyers and aircraft carriers fast enough to keep pace with Chinese shipbuilding capacity. It's just not possible.
So they need to supplement the fleet with cheap autonomous mass, unmanned ships that can go out and patrol or lay mines for months on end without a single crew member.
That's the vision. And Leidos doesn't want to build the steel hulls of the ships.
Yeah.
They want to own the brains, the autonomy software that drives them. That's the high-margin, sticky part.
Got it. So space and maritime is pillar 1. What's number 2?
Pillar number 2. This is the big one we're going to spend a lot of time on today. It's energy infrastructure.
Okay.
And the key here is that they are explicitly reframing the electric grid, not just as a civilian utility issue, but as a core national security issue.
The grid as a battlefield.
The grid as the foundational layer of national security. If the grid goes down, the radars go down, the data centers that run the intelligence community go down, the hospitals go down, the country stops.
So securing the grid is as important as building a fighter jet.
They would argue it's more important. Okay, pillar 3 is digital modernization and cyber. Now, this sounds like their old business, but it's different. This isn't just about fixing the government's computers. We're talking full-spectrum cyber operations. That means defense protecting networks, but it also means offense.
Ah, the high-end spy stuff.
Well,
This is where that Kudu Dynamics acquisition they made a while back comes into play, right?
precisely. Kudu is all about those very high-end, bespoke cyber tools for the intelligence community. Very high margin, very sticky.
Okay, makes sense. What's pillar 4?
Pillar 4 is mission software. Again, this sounds like an old business, but the focus is on speed and security. This is not about building a new accounting system for the IRS that takes 10 years.
This is an off-the-shelf Microsoft Office.
No, this is about rapidly developing custom, secure software for warfighters. Targeting systems, battle management software, things that have to work perfectly when people are actively shooting at you. It's a very different discipline.
Okay, and the 5th and final pillar.
The 5th is managed health services. Now, this is one of their legacy strengths. It's specifically focused on veterans and public health.
The VA medical exams, the digitization of military health records, that sort of thing.
Exactly. This has historically been their cash cow, the engine that funds a lot of this other stuff. But as we'll discuss later, it's also become their single biggest point of risk.
Okay, we'll definitely circle back to that. So those are the 5 pillars. But, I've seen this 1,000 times. A company puts out a press release with a bunch of pillars, and a fancy strategy name, and then absolutely nothing changes about how they actually operate day to day.
The classic disconnect between the PowerPoint deck and reality.
Exactly. We're an AI company now, says the company that sells 2x4s. So are they actually changing the structure of the company to align with this, or is it just talk?
No, they're completely reshuffling the entire deck,
Okay.
starting with fiscal year 2026, which, for government contracting, effectively started last October. They are reorganizing the whole company into 4 brand new reporting segments.
Okay, now that's a real signal. How a company organizes its P&L tells you what management actually cares about. So break down the 4 new segments for me.
Okay, segment 1 is called National Security and Digital. That's where all the high-tech spy stuff lives. Your cyber work from Todo, the Intel community support, the high-end surveillance tech,
The spooky stuff. Got it.
the spooky stuff. Segment 2 is Health. Pretty straightforward. That's the VA work, the Military Health Records Program. They're keeping that as its own distinct business unit, which is telling.
Okay.
Segment 3 is called Homeland.
Homeland. So like
Yeah.
Department of Homeland Security work, TSA, border control.
It includes that, yes. The airport scanner business lives there, the work they do for the FAA. But, and this is the really critical part, Homeland is also the new home for their entire energy sector.
Oh, that's interesting. So they are organizationally, on the financial statements, explicitly linking energy infrastructure with Homeland Security.
They are telling the world and their investors that keeping the lights on is an act of homeland defense. It's not just a commercial enterprise.
That's a very powerful psychological framing. I like that. Okay, what's the 4th and final segment?
The 4th is defense. This is the kinetic side of the house. The hardware, the missiles, the space systems, the autonomous ships we talked about, the stuff that goes boom.
So you have the spies in national security, the doctors in health, the grid builders in homeland, and the war fighters in defense.
That's a good way to summarize it. The new structure perfectly mirrors the NorthStar strategy. It's not just talk.
Okay, the intent is clearly there. But let's get to the thing that really leaped off the page when I was reading the 8K this morning. The money. They just agreed to spend $2.4 billion in cash to buy a company called Entrust Solutions Group.
This is the headline. This is the big one. This is the move that proves to everyone they're absolutely not joking about this energy and infrastructure pivot.
I have to admit, I cover the defense and aerospace sector pretty closely, and I don't think I've ever heard of Entrust Solutions Group. They're not at the usual defense industry cocktail parties. So who are they, and why is a company like Leidos buying a utility engineering firm?
So Entrust is a pure-play power design and engineering firm. They design infrastructure for electric utilities, gas pipelines, and big industrial power users.
And what does this do for Leidos in terms of scale?
It's transformative. Before this deal, Leidos had an energy business doing about, say, $600 million a year in revenue. This deal adds another $700 million on top of that.
So it more than doubles their energy business overnight.
It doubles it to a roughly $1.3 billion run rate business. Overnight, they become the number 3 provider of transmission and distribution engineering in the entire United States.
Wow.
And the number 4 overall power engineering firm. They go from being a kind of niche, interesting player in the space to a dominant market leader instantly.
Okay, but again, the why. I get that the grid is important. I get the national security angle. But $2.4 billion is a massive check to write. That's real serious money. What is the deep logic here? Is it just because we have a bunch of old power lines that need replacing? Because that sounds like slow, steady, kind of boring growth.
It would be if that were the whole story. But you have to connect the dots to the biggest technology trend on the planet right now.
Artificial intelligence.
Artificial intelligence. And more specifically, the data centers that power it.
They use a ton of electricity.
A ton is the understatement of the century. We are talking about a step change, a fundamental shift in global power consumption. A simple Google search uses a tiny, tiny fraction of the energy that a single query to a model like ChatGPT-5 uses.
And the models are only getting bigger.
Exponentially bigger. The data centers that run these things are becoming absolute energy black holes. We are, and this is a term you're going to hear a lot, entering an energy supercycle.
A supercycle.
Yes. Estimates are that U.S. utilities are going to have to spend at least $1 trillion, that's a trillion with a T, over the next decade, just to modernize and expand the grid.
And they have no choice.
They have no choice. The current grid, as it exists today, simply cannot handle the load that all of these planned AI data centers are going to demand in 2027, 2028, and beyond. We're looking at a future where a single data center campus might need a gigawatt of power.
That's the output of a nuclear power plant for one data center.
For one data center. So Leidos isn't just buying a boring utility company. They are positioning themselves to be the master engineers who build the pipes for the entire AI economy.
They're selling the picks and shovels during the AI gold rush, but the gold is electricity.
That is the perfect analogy. And Entrust fills a very specific capability gap for them. You see, Leidos was already pretty good at the transmission and distribution side of things.
So the T&D, the wires, the poles, the substations that move the power around.
Right. What Entrust brings to the table is deep expertise in power generation and gas infrastructure.
Power generation. So designing the actual new power plants that we're going to desperately need.
Correct. Designing them. And the gas infrastructure piece is critical because, let's be realistic, for the next couple of decades, natural gas is going to be the bridge fuel that provides the reliable baseload power for these data centers.
Because renewables are great, but they're intermittent.
The wind doesn't always blow, the sun doesn't always shine. An AI data center cannot tolerate that. It needs 99.999% uptime. That means you need baseload power.
So now Leidos can go to a utility or even directly to a big tech company like Microsoft or Amazon and say, we can design the new gas-fired power plant, we can design the pipeline that feeds it, and we can design the high-voltage transmission lines that take the power from the plant to your new data center.
It's a complete end-to-end engineering solution.
Okay, now you used a very specific word there, design. You didn't say build. I want to double-click on that because in the world of big infrastructure projects, that is a massive, massive distinction.
It is the critical distinction. This is what we in the industry call pure play engineering. Leidos, with Entrust, will design the systems. They'll do the advanced math, the blueprints, the regulatory consulting, the environmental impact studies.
But they will not pour the concrete.
They will not pour the concrete. They will not weld the pipes. They will not be the ones with thousands of workers in the field.
Why is that so important for an investor to understand?
Because pouring concrete is an incredibly risky, low-margin business. That's the EPC, model engineering, procurement, and construction. In the EPC world, if it rains for a month straight, your project gets delayed and you lose your shirt.
If the price of steel suddenly spikes because of a trade war,
your margins are vaporized. It's a brutal business. If you're just doing the engineering, on the other hand, your margins are high and they're predictable. You get paid for your intellectual property, for your brain power, not for your exposure to commodity prices and weather.
So Leidos is deliberately avoiding the construction risk while capturing all the upside from the design growth. They want the IP, not the liability.
That's a perfect way to put it. It keeps them in that asset-light model that technology investors love. They're not buying a bunch of bulldozers.
It's very smart. But Leidos claims to be a technology company. Is this just a deal to buy a bunch of traditional engineers with hard hats and T-squares, or are they bringing some of their own tech magic to this acquisition?
This is where the whole story clicks together. This is the synergy. Leidos has a proprietary in-house AI tool that they call Skywire.
Skywire. That sounds like something out of a James Bond movie, the villain's evil satellite network.
It does have a certain flair to it, but what it actually does is automate large parts of the engineering and design process for grid infrastructure.
How so?
It uses AI to optimize everything: the routing of new power lines, the placement of substations to minimize power loss, the load balancing calculations. Leidos has claimed in the past that Skywire has delivered on average a 30% efficiency saving in their existing engineering design work.
Hold on. 30%. 30.
30.
In an industry like engineering, that's not an incremental improvement. That's a revolution. Usually you're fighting for a 2 or 3% gain.
It's a total game changer. It's what's known as generative design. So instead of a human engineer painstakingly drawing one possible route for a power line on a map, the AI can generate and analyze 10,000 possible routes in a matter of minutes.
And it considers all the variables, the terrain, the cost of land acquisition, environmental regulations.
Everything. And then it spits out the top 3 most optimal solutions for the human engineer to review.
So the plan is you buy a traditional engineering firm like Entrust, which is probably full of very smart people but relies on manual processes. You take their backlog of work, you apply the Skywire AI tool, and suddenly your newly acquired engineers are 30% more efficient.
Which means you can bid on contracts lower than your competitors and still make a higher margin. That is the core of the financial model for this deal. That's how they're going to get their return on that $2.4 billion.
They're buying the revenue stream, but they're planning to inject technology to increase the quality and profitability of that revenue.
That is the velocity concept from the NorthStar strategy made real, using technology to do the job better and faster.
And it's worth pointing out, this is part of a pattern. They're not just buying, they're selling too. They recently divested a legacy business.
They did. In October of 2025, they sold off a company they owned called Verec. It was a fine business, but it was focused on oil and gas inventory management. It was slow growth, didn't really fit the new high-tech, high-growth model.
So they're actively curating the portfolio, selling the slow stuff and using the cash to buy the fast stuff. Very disciplined.
It's a sign of a management team that knows exactly what it wants to be.
Okay, speaking of fast stuff and AI, we've talked about Skywire, which is their own internal engineering tech. But the other huge piece of news in this report is the strategic partnership with OpenAI.
Yes. This is the shiny object that gets all the headlines.
And I have to ask, I'm going to be the skeptic here. Every company on planet Earth has an AI partnership press release right now. My local coffee shop probably has a strategic alliance with an AI.
It feels that way, doesn't it?
So is this just a fancy press release designed to pump the stock? Or is there real substance here?
I think this one is very real, and I'll tell you why. They aren't just giving their employees a corporate ChatGPT account and telling them to, have fun. They are deploying what they call agentic AI into specific government workflows.
Okay, you have to stop there. Agentic. That's a word we're starting to hear more, but I think most people still think of generative AI. What is the difference? Why does that word matter so much?
It's a crucial distinction. Think of it this way. Generative AI is like an artist. You give it a prompt, you ask it to write a poem, and it writes a poem. You ask it to create an image, it creates an image. It's brilliant at creating new content based on your instructions.
But it's reactive.
Yeah.
It waits for you to tell it what to do.
Exactly. Agentic AI, on the other hand, is more like an employee. It has agency. You don't give it a prompt, you give it a goal.
A goal.
A goal. You could say to an AI agent, monitor all open source intelligence for signs of supply chain disruption for semiconductors in Taiwan and provide me with a summary report every morning. The agent then figures out the steps it needs to take. It decides to scan news sites, monitor shipping logs, checks social media in the region, synthesizes all that data, and then writes the report. It can chain thoughts and actions together to achieve the goal.
So generative is a creator, agentic is a doer.
That's a perfect way to put it. And Leidos is building these custom agentic workflows for their government clients. The use cases are incredible. Think about global threat assessment.
An analyst at the CIA or the NSA is just drowning in data.
Drowning. There are millions of intelligence reports, satellite images, signals, intercepts. No human team can possibly process it all. An AI agent can scan all of it, 247, looking for subtle patterns and connections that a human would miss until it's too late.
Or something like deepfake detection. That has to be a massive national security priority right now.
A huge issue. With the 2026 midterms coming up and just the general level of global instability, deepfakes are a weapon of mass confusion. Leidos is using this OpenAI partnership to build tools that can automatically detect and flag manipulated media for intelligence agencies.
What are some of the other use cases?
Supply chain monitoring is another big one. And critically, they're using a specific tool called Trustable for AI governance.
Trustable. What does that do?
It's basically an AI safety and governance platform. It puts guardrails on the AI. It makes sure the agent doesn't go rogue, that it doesn't hallucinate or make things up, and then it adheres to all the strict ethical and legal guidelines set by the Department of Defense. Because the government is, and rightfully so, incredibly paranoid about this technology.
That's the whole catch, isn't it? An intelligence agency can't just plug its classified data streams into the public version of ChatGPT.
Absolutely not. You can't put nuclear launch codes into a public model. And that's the value proposition that Leidos is offering here. They are providing a secure configuration, a walled garden. They are the bridge between OpenAI's bleeding-edge technology and the government's obsessive, mission-critical security requirements.
So they're the trusted broker.
The trusted broker?
I like that
A
one.
very lucrative place to be. If you own the secure bridge, you get to charge a toll for everyone who wants to cross. Leidos is saying to the DoD, you can have all the power of the most advanced AI in the world, but wrapped in our trusted Leidos security blanket.
And they're applying this internally too, right? I saw a note in the report about something called a transformation office.
They're eating their own dog food, taking their own medicine. They've set up this internal office specifically to find ways to automate their own back office functions using these AI agents.
And the prime example was billing.
Yes, billing. Government contract billing is a legendary nightmare of bureaucracy and red tape. Every single invoice has to be formatted perfectly with all the right codes, or it gets rejected and sent back.
I can't even imagine paperwork.
It's a huge source of friction. So they're using AI agents to automate the creation and submission of these invoices, which helps them reduce their day sales outstanding, or DSO.
DSO, which is basically just the average number of days it takes you to get paid after you've done the work.
Right. And in this industry, it can take a long, long time. If an AI agent can help Leidos get paid just 10 days faster across the entire company, that frees up literally hundreds of millions of dollars in working capital.
That's real money that hits the bottom line. Money they can use to pay down the debt from the Entrust deal or fund R&D or return to shareholders.
It's efficiency that translates directly into cash flow. It's a perfect example of how this isn't just hype. It's a tool they're using to make the business run better today.
Okay, so we've covered the pivot to energy. We've covered the AI force multiplier. Let's talk about the third pillar of this transformation. Defense tech, hardware, the Golden Dome.
This is where we see the company pivoting from its roots in software and services back into the world of manufacturing physical hardware. And the biggest, loudest signal here is their plan for capital expenditures, or CapEx.
You always have to follow the money. Where are they spending their own cash?
In 2026, Leidos is planning to triple, not double, triple their CapEx budget to $350 million.
Wow, $350 million. You don't spend that kind of money on new laptops and ergonomic office chairs.
No, you spend that kind of money on factories, on assembly lines, on tooling. They are building out their physical capacity to manufacture munitions and unmanned vessels. This is a hard, undeniable pivot into manufacturing.
And I saw they're building a specific new facility in Maryland.
Yes, in Princess Anne, Maryland. It's a new facility dedicated specifically to hypersonics and advanced payloads.
Hypersonics, the missiles that can fly at more than 5 times the speed of sound, the technology that the U.S. has been racing to catch up to China and Russia on.
Correct. The DoD is pouring billions into this space, and Leidos is investing its own capital to become a key manufacturer in that supply chain. They're not content to just write the guidance software for the missile anymore. They want to build the physical components that go inside it.
And this Golden Dome concept, what exactly is that? It sounds biblical, or like something out of a science fiction movie.
It's their internal branding for their integrated air and missile defense work. Think of it like the Iron Dome system that protects Israel, but scaled up to protect critical U.S. military bases around the world.
Protecting places like Guam from Chinese missiles or bases in Europe from Russian threats.
Exactly. And they are landing some massive wins in this area. They just won the ABD-SMD award.
ABD-SMD. Okay, you have to translate the acronym soup for me.
It stands for Advanced Battle Management and Directed Energy System for Maneuver Defense, I think. But what it really is a comprehensive base defense system. And it's a $2.2 billion award.
$2.2 billion. That is a monster win.
It's a huge win, and it validates their strategy. It shows that the military now sees them as a prime systems integrator for complex defense hardware, not just as an IT services shop. It's a kinetic contract.
And they also got a spot on that huge shield ODQ, right?
Oh, they did. Now, IDIQ stands for Indefinite Delivery, Indefinite Quantity.
Which in plain English is basically a hunting license.
It's the perfect way to describe it. An IDIQ doesn't guarantee you any money up front, but it gives you the right to be at the table and compete for the money. It means you're pre-approved to bid on future task orders under that contract vehicle.
And the shield vehicle is enormous.
The total ceiling on it is $151 billion.
$151 billion.
Yes, across all the multiple vendors who won a spot. Leidos won't get all of that, obviously. But being one of the chosen companies at that table is essential. If you're not on the IDIQ list, you can't even play the game, and Leidos is at the head of the table.
And what about the unmanned ships we mentioned earlier? I saw something in the notes about the Navy's MUSV program.
Yes, the Medium Unmanned Surface Vessel. This is a top priority for the Navy. They are going all in on these drone ships. And Leidos is providing the autonomy software, the secret sauce, the brain that actually drives the boat, as well as the modular mission packages.
So they're not just building the steel hull, they're building the intelligence.
Exactly. Building the hull is a low-margin business. Shipyards don't make great money. Building the reconfigurable brain of the ship, the part that can be updated with new software every year, that's where all the value is. And again, this ties directly back to that NorthStar strategy. They are selling an autonomous solution, not just a physical product.
Okay, so the story is incredibly compelling. You have the energy pivot, the AI multiplier, and the defense hardware push. It's a three-legged stool that looks very, very stable. But let's get to the report card. They released their full fiscal year 2025 numbers this morning. Stories are nice, but numbers don't lie. So how do they actually do?
It was, on the whole, a very strong year, but there's a little bit of noise at the end of it that we need to explain. For the full year, revenue came in at $17.2 billion. That's up about 3% year over year.
Okay, solid growth. But I did see that fourth quarter revenue was actually down 4%. And you know that anytime a growth-oriented company posts a shrinking number for the most recent quarter, investors start to get nervous.
It immediately looks like a red flag. Is the business slowing down? But in this case, management is making a very strong case that the decline is optical, not structural. And when you look at the math, they have a point.
Okay, walk me through the math. Why shouldn't we be worried about that negative 4%?
There are two main reasons. The first is a simple calendar quirk. The previous fiscal year, 2024, had a 53rd week in it. It's an accounting thing that happens every 5 or 6 years.
So you're comparing a normal 13-week quarter in Q4 of 2025 to a 14-week quarter in Q4 of 2024.
Exactly. Of course the revenue is going to be down. You are comparing it against a period where they had an entire extra week of work and billing.
Okay, that's fair. That's just calendar math. That happens. What was the second reason?
The second reason was the 6-week federal government shutdown that happened in the fourth quarter of 2025.
Oh, right. I think I tried to block that out of my memory, but yes, that definitely happened.
When the government shuts down, a lot of contract work just stops. Non-essential personnel can't go to their offices, invoices don't get processed, you can't bill for the work.
So it's a forced unpaid vacation for a big chunk of their business.
It is. So if you normalize the numbers for those two effects, if you take out the impact of the extra week from last year and you add back the estimated lost revenue from the shutdown, the underlying growth would have been about 4%.
So the core business is still growing at a healthy clip, even if the headline number looks negative for the quarter.
That's the argument, and it's a pretty convincing one.
Okay, so revenue is solid. What about profitability? Because as the saying goes, revenue is vanity, profit is sanity.
That is the real star of the show in this report.
Oh.
Their adjusted EBITDA margin hit a new company record of 14.1%.
14.1%. For a government services and tech company, that is an elite number. Usually you see their peers, the Booz Allens, the CACIs of the world running at maybe 10 or 11%.
Exactly. A 14% margin is almost getting into software company territory. This is the proof point for the entire efficiency story. It shows they are getting much, much better at converting every dollar of revenue into actual profit. They're cutting overhead, they're using that internal automation we talked about, and they're shedding the low-margin body shop work.
And that profitability leads directly to cash flow.
A torrent of it. They generated a record $1.75 billion in operating cash flow for the year.
And it's that river of cash that gives them the firepower to go out and make a $2.4 billion acquisition like Entrust.
It's a virtuous cycle. The cash engine is fueling the transformation. If they were a cash-burning company, they could never make these kinds of bold moves, but they are printing money. And they're not just hoarding it either. They returned about $360 million to shareholders in the fourth quarter alone through stock buybacks and dividends.
Okay, so let's look forward to 2026. What are they guiding for the year ahead? Because the market always trades on the future, not the past.
Their revenue guidance for 2026 is a range of $17.5 billion to $17.9 billion. So continued solid growth. And of course, they're guiding for that tripling of CapEx to $350 million to build out the new factories. They are reinvesting the cash right back into the highest growth parts of the business.
How are they paying for the Entrust deal? That's a big check to write. Are they diluting shareholders by issuing a bunch of new stock?
No, there's no massive share issuance planned. The financing is pretty straightforward. They're using $500 million of their own cash on hand. Then they're issuing $500 million in commercial paper, which is basically short-term corporate IOUs. And the remaining $1.4 billion will come from new long-term debt.
Does that new debt load worry you at all? Does it put the balance sheet at risk?
It definitely pushes their leverage ratio up. It'll go to about 2.6 times their EBITDA. That's a little higher than it has been. Usually, these conservative government contractors like to stay under 2.5 times.
So it's not insignificant.
It's not. But for a company that generates this much cash, it is very, very manageable. They have a clear path to pay that debt down quickly over the next couple of years. They aren't stressing the balance sheet to the breaking point. It's an aggressive move, but it's a calculated one.
Okay, so the strategy is sound, the financials are strong, the big acquisition makes perfect sense.
Yeah.
But we're not cheerleaders here. We're investigators. So where's the body buried? What is the big risk? Because there is always a risk. If a story sounds this good, there's usually a catch.
There is one. There is one massive blinking red light risk that we have to talk about. We call it the golden goose.
The VA contract.
The VA medical exam contract. Historically, this one single contract and the broader managed health segment it sits in has accounted for something in the neighborhood of 30% of Leidos' total earnings.
30% from one customer on one contract. That is a terrifying level of concentration. If you lose that one contract, you lose almost a third of your profit overnight.
It is the definition of a single point of failure. It's been a wonderful, profitable business for them for years, but it's a huge risk. And here's the kicker. That contract is up for recompete in the middle of 2026.
So basically tomorrow in government contracting time.
It is coming up very, very soon. The government is required by law to periodically rebid these massive contracts to ensure they're getting a competitive price. And if Leidos loses that contract, or even if they keep it but the margins get squeezed down because a competitor underbids them,
the stock takes a major hit. There's just no way around that.
No way around it. And looking at the details in their guidance, it seems like there's already some pressure in that segment.
There is. They're guiding for some margin pressure in the health segment in 2026, regardless of the recompete outcome. There's another big program in there called DHMSM, the Defense Healthcare Management Systems Modernization Program.
Right.
That program is transitioning from the higher margin build phase to the lower margin long-term sustainment phase. That's a natural margin headwind. And at the same time, new competitors are entering the medical exam space. It's getting more crowded.
So if I'm an investor or even just someone trying to understand this company, that VA recompete is the big binary event that I need to have circle on my calendar. It's kind of a coin flip that could have a huge impact.
It's the single biggest risk point in the entire story, period, however. This is exactly why the Entrust acquisition is so strategically brilliant.
It's diversification. It is a massive dose of diversification. By doubling the size of the energy business, they are building a powerful new growth engine that acts as a buffer. If the VA contract shrinks or even goes away entirely, the fast-growing energy business can help offset that loss. They are actively de-risking the overall portfolio by pivoting to infrastructure.
They're reducing their dependence on the golden goose before the goose has a chance to get sick.
Or fly away to a competitor. They're buying a new goose, a very healthy goose that's poised to grow for the next decade.
Risk defined, portfolio protected.
You're stealing my closing line.
I'm just borrowing it. It fits the situation perfectly. Okay, so let's bring this all together and land the plane. We have a company in the middle of a profound transformation, moving from a low-margin body shop to a high-margin tech powerhouse. We have a massive smart bet on the energy grid and the AI supercycle. We have a hard pivot into defense manufacturing. And we have this one giant looming risk on their biggest legacy contract. So what's the final verdict?
For me, this is a high conviction hold and a definite long-term buy.
Okay, explain the hold part. If the story is so good, why not just say it's an immediate buy?
Because the fundamentals are absolutely elite. The margins are fantastic. The cash flow is a monster. The NorthStar 2030 strategy is, in my opinion, the exact right strategy for the world we're living in. The pivot to energy is brilliant, but that VA contract recompete risk is just too big and too near-term to ignore. It creates an overhang on the stock that keeps me from going all in right this second.
You want to see how that event plays out first.
I want to see how the recompete plays out. I want to see what the terms of the new contract look like. But if you have a 5-year time horizon,
If you're looking out to 2030,
then yes, I think this is a fantastic company to own. If you believe in the strategy, this is a company that is positioning itself at the absolute nexus of the two most important secular trends in the world: national security and energy resilience. They are building the critical systems that our country literally cannot function without.
that brings me to my final provocative thought for you, the listener. We've talked about the grid, we've talked about hypersonic missiles, we've talked about AI spies. But when you take a step back and look at the whole picture of what Leidos is building, this combination of cyber defense, energy engineering, and military hardware, it raises a really interesting question.
What's that?
In a 21st century world of AI-driven warfare, autonomous drones, and pervasive digital threats, is the electric grid actually the single most critical weapon system of all? Think about it. If the power goes out, the AI doesn't work. The data centers that run our intelligence agencies go dark. The radar systems stop spinning. The missile silos don't get the command to launch.
If you can't protect the grid, you can't fight the war.
You can't do anything. And looking at this massive $2.4 billion bet on Entrust, it seems to me that Leidos might be the only major defense contractor that is treating the stability of our power grid with the same level of strategic seriousness as a new fighter jet or a hypersonic missile. They're making a huge bet that in the future, electrons are going to be just as important as bullets.
That's a fascinating way to frame it. And judging by the direction the world is heading, they might just be right.
Something to think about the next time you flip on a light switch. That's all for this deep dive. Risk defined.
Portfolio protected.
We'll see you next time.